Hey guys, Toby Mathis here, and today we're going to be talking about the #1 tax strategy for day traders. But in order to get there, I got to explain what a day trader is, what the tax issues are, and then what's the best loophole to make sure that you don't have to run the gauntlet, so to speak, of all these rules. And let me just kind of lay it out for you. The IRS does not have tax code to go off of when it comes to what is a day trader or what is a trader. They do have something called trader and securities, and it's taught in topic 429. But it is not a reg and it is not law. Instead, because of that, you end up going with a facts and circumstances test, which means you go to court a lot. And that's what's happened. And let me explain why this has happened. So, no code provision that says, hey, you are a trader in securities, so we end up having to do facts and circumstances. Why does that even matter? And so I'm going to lay it out really easy. There's investors, and there are traders. And the big difference from a tax standpoint kind of goes like this. An investor gets to write off deductions under Section 212. Under the Tax Cut and Jobs Act, man, a lot of deductions went away, all the miscellaneous itemized deductions. So what 212 allows you to write off is essentially income up to your margin interest. You get to write off the margin interest up to the income. So there's really not much there. Perhaps you might be able to get some advisory, maybe some tax fee, but even that is questionable depending on the type of structure you have. For the most part, investors do not get ordinary and necessary business deductions. That flies under Section 162. And Section 162 says that a trader business can write off ordinary and necessary business expenses for the production of income in that business. And so to do that, like most people are used to this as an individual, they would be filing something called a Schedule C and becoming a sole proprietor. And so what traders did is they started filing Schedule C, Schedule C, whereas our friends the investors were stuck everything on Schedule D. Now imagine that you are the IRS and you're trying to make heads or tails of somebody's return, and they're reporting income on Schedule D, but they're writing off expenses on Schedule C. That means you're going to get audited, guys. That means you have no income. There's something called a hobby loss rule, and the #1 category, that when we used to keep stats up until about 2019, you could see who they like to audit. And you know who they love to audit? Sole proprietors. Like, they always figure that sole proprietors are overstating their expenses and understating their income. So by doing this with zero income on your Schedule C, instead the income was all going on Schedule D because it was capital gains. Both of these, both investors and traders get capital gains and capital losses, by the way. And that's going to trip some of you guys out. There is a way around that capital loss as a trader. I'll get into it in a second. But what this meant is that these investors get very few deductions. They're reporting everything as capital gain, and then when they have losses, the capital losses could only be used up against capital gains, with one exception. They can write off up to $3,000 of extra loss a year against their other income sources. So there's a cap on how much loss you can have. So if you have a bad year, you sell a bunch at a loss, you have a $30,000 loss, and you have no capital gains to offset, you can write off $3,000 a year. So you're going to be writing off that $30,000 against your other income for, if it's $30,000, it'll be 10 years, right? Unless you have some other capital gains. So trader status, what it allows you to do is take those deductions, but you're still reporting the income as capital gain income. Now, this is why this is important. Because if you're running a business, one of the benefits of running a business is that you can put things into like a 401k, that you can contribute to HSA, to IRAs, that you can do all these different types of deductions. What trader status gives you is the ability to write off certain deductions, but your losses are still limited, and you can't contribute to retirement plans and things like that. So I'll get into the loophole in a second of how you take this and you actually turn it into something where you can fix it. But I told you that the capital loss, this is an issue for a lot of people that are in that world, because day traders especially, about 90%, depending on which study, and this always gets me hate mail, about 90% of you lose money. Right? It is not something that day trading has not been proven to be easy to replicate and successful over a long term for a lot of people. You may be one of the exceptions. It's not 100%, but about 90% plus of people lose money consistently in significant amounts. They are limited in their loss. So what you have is this something called mark-to-market election. Section 475, and you make an election, you say, hey, I want to treat my activities as though I'm liquidating everything at the end of the year, and as a result, my losses are now ordinary. So by doing that, my losses equal ordinary. And what does that mean? It means I can use them against my W-2 income. I can use them against my other income sources. So you're now looking at this going, boy, I want to be a trader so I can write stuff off, and boy, that mark-to-market looks kind of good. Now, I'm not a fan of mark-to-market. And the reason being is because most of my clients, they're not just day trading. They have a structure where they have a family office and they're investing for the long term. They're creating multiple streams of income. They're doing covered calls, wheel strategy, which is cash secured puts. They're making money in multiple ways on the same stocks. They're making dividends. They're doing all these different things, and they have a company that manages it, a family corporation or a management or a family office, whatever you want to call it. I'll just call it a management company, and I'll show you the loophole and how it works. But that's what they're doing because they don't want to get stuck in a situation where they have an artificial rule that says treat all my stock as being sold. Why not? Because I am old enough to remember when Qualcomm ran up at the end of the year. I had clients that were doing leaps on this thing. At the time, that was kind of in, it was a huge run. I think it went up $600 in a period of like 60 days. And we had clients that were millionaires overnight. The problem was if they didn't sell and pay the tax, mark-to-market treated them as if they had sold. So a lot of these folks were working with these trader groups out there, these CPA firms that are like, hey, I'll make you a trader. And they did not consider what would happen if under mark-to-market they were treated as though they sold those securities, but they never sold those securities. So these things are leaps. These are long-term options. They made a fortune, and then the company went in January, March, and April. In fact, by April, it was back to where it was. So you have to pay tax on that gain, even though you didn't receive it under mark-to-market. It's treated as though you sold all your securities on December 31st, and these people just got torn up. So it's like whenever you talk to your grandparents about the Depression, they're like, I'm always going to save, because they saw what happens if you didn't. Well, I'm just telling you, anybody that went through that in 2008 again, where you had it just dropped off a cliff and you had these massive loss and you're stuck on paying gain that you never actually received under mark-to-market, not my favorite. So that's not something that I particularly care to do. You could do that if you're a trader, but you want to do so with your eyes wide open, because if you do have positions that you're holding for a longer period of time, you have an issue. Now let's talk about what it means to be a trader, how you actually qualify. Because what we have is kind of this rules-based out of the court cases, out of the topic of 429, you have these different things. You want a short-term profit motive. Like, so there's three things you need. And I'll kind of just, maybe I'll just write them up over here. One, short-term profit, STP. If you are holding companies in positions over 30 days, or if your average hold period is 30 days or more, you do not qualify. You're done. This is short-term swings, daily swings of the market. You're in and out. You are truly a day trader. If that's you, you're going to meet this first one. You go over hold periods, average of 30 days or more, you're toast. You're never going to be a trader. Number two, substantial activity. What does substantial activity mean? It means that you are doing a lot of trades. I would say 750 trades is a minimum per year, in and out, 750 times. Make sure that you have a ton of trades, because you get to that line, facts and circumstances. You know where they go to get facts and circumstances decided? Tax court. You're audited. You're going to end up having to prove yourself. It's such a pain in the katush. I wouldn't wish it upon somebody. I don't want this for my clients. I don't go this route because I don't want this for my clients. I don't want to get audited. I want to just live my life and get out of it. But you also have to have, beyond the substantial amount of trades, you also have to have a substantial amount of money invested. They want to see that that's your primary source of income. It doesn't mean that you could be a doctor and have a $25,000 trading account. And you're like, oh, I'm doing a ton of trades, I'm a trader. They're going to say it's not substantial. And then number 3, you want continuous and regular. And what does that mean? So if substantial is, how would I do this? More than 750 trades per year. This is more than 70% of the trading days. You need to be actively involved in that market on a daily basis for the majority of the year. This is not something where there is a case where somebody made a bunch of money in a few months and then said, I'm going to take the rest of the year off. No longer a trader. Because they say, oh, a trader business doesn't take time off. You haven't been around a lot of the businesses I know, or these guys are seasonal. They might be in there for a month, 2 months. I have a friend that does a haunted house every year. Yeah, he's in there for 2 months. Okay, that doesn't count, right? They're applying rules to traders that they don't apply to everybody else, which is kind of, unfortunately, unless Congress ever takes this up and gives us bright line rules, I don't want to be anywhere near this. So what do you do instead? So I'm looking at this going, okay, I definitely, like if I have a world, I want to be over here, but what could I do? What is the loophole that I could do, even if I'm a trader, so that I could still get some benefits out of this? Like maybe you want to be able to do retirement plans. Maybe you want to be able to fund things. Maybe this is your livelihood. Then my comment to you would be to actually create a structure, and it looks like this. This is a C corporation. And it owns a piece of an LLC, generally Wyoming, so that we have privacy and nobody can ever take it from us, but that's a topic for a different day. But I have a Wyoming LLC, and that corporation is probably going to own 25% plus, maybe 25 to 30% of that LLC. And it's going to be the managing member, or it's just going to be the manager of that LLC. That LLC is going to have the brokerage account, and it's going to be taxed. I'm going to put 1065 for all you accountants know what it is. That's a partnership return. And there's 2 reasons why we're doing this. Number 1, if this thing makes money and the C Corp is managing that portfolio, it's probably going to be doing other things as well. I like it to manage like real estate, maybe it's doing education for your family, financial education so it can continue to manage the other LLCs in your household, especially if you have real estate, your other investments and things like that. But I'm going to run that. I'm also going to run out of the C Corp. I'm going to have my home office, which is the administrative office. I'm going to be doing something called 280A, which you haven't heard about. That's the Augusta rule. I'm going to do all of my expenses, so I'm going to do all my other expenses. All of that out of that corporation, and that is my family office. That is doing all the stuff that is managing my portfolio that's going to allow me to create a legacy for my family beyond just my life. Like these are things that these people they should be sitting on the board. If you have kids, your family should actually be involved in this, and you may want to do side businesses out of here. There's lots of things you could do, because all this guy is doing is acting as the complete management of all your investments in businesses in your family, including this one, where we have trading going on. And if we make $100,000 down here, 25 of it goes up here, and that's where we're writing off our expenses. 75 flows down to you, there's you, toot, toot, and continues to go on this is going to actually go on Schedule E, page 2. And it's going to still be capital gains. This is a nice little structure, by the way. This works so well for so many people as a great backbone to their entire management of all their affairs. When we put together an asset protection structure, we're usually looking at 4 things. We're looking at asset protection, we're looking at tax savings, we're looking at business, the ability to actually get loans and to continue to grow your business and to continue to prosper, and we're looking at legacy, the ability to create something that lives beyond you. This works really, really well with that. Not only can they never touch this asset, but now we're getting deductions that we wouldn't otherwise have received, and we're not having to jump through a bunch of hoops. If you want to pay a 401k out of this, you certainly can. If you want to put your kids on payroll or pay them, yes, you can. There's just so many things that you can do once you create this structure. And by the way, if you're saying, but that's not enough, Toby, I have other expenses. I have other things, I need to be able to pay more out of here than this 25%. Well, you could increase the ownership amount, or you could do what's called a guaranteed payment to partner. In other words, you say, hey, as long as it's reasonable, and you would document and say, how much would it cost for someone to actually be my family manager, to be the person that manages this entity? And you create a contract between the LLC and that corporation, because it is a partner, but I'm going to have a guaranteed payment that goes up here. Let's just say it's $2,000 a month. Then the first thing that comes off of that $100,000 is the $2,000 a month. And so that would give me down to $76,000 net. 25% of that would go up here, 75% would flow down to me. That's another way, but it has to be a guaranteed amount. It cannot be tied to profit. It has to be arm's length. You want to have somebody look at that. That's what, why you use an accountant, attorneys to document these things, is you want to make sure they're reasonable and that, hey, this actually bears some semblance of reality, right? Like, this is what we're doing, is we're creating our family office to manage this thing. We create this scenario and it works really, really well. Now, by the way, I've done other videos on this. There's a few others you could take a look at. The other thing you could do, absolutely free, is come to our tax and asset protection event. We put them on almost every Saturday, and then we do special ones on trading periodically. So if you just go to the link, I'll put it in the show notes, you can absolutely do that. There's no cost to this. We love to educate. And if you could do one thing for me, number one, go down in comments and write your questions, because that helps other people read those, and it helps us get an idea of feedback. And number 2, like and subscribe, and even hit that little bell so that you get notified when things come out. But it helps our algorithm out immensely if you like and subscribe. And other than that, put your questions down below and watch these next videos. I'll put some more trader videos up for you so you can take a look, and there might be some ones that get into some more of the deeper dive on the tax side that you could look at too. Good luck, guys.